All right, I guess we're live. So, all right, thank you, gentlemen, for joining us today. Really, a lot of questions have been coming in over the last week. There's such turbulence in the market and so much happening, and obviously, we have a world class portfolio management team, and we wanted to kind of have an AMA today to address some of the points that have been coming up. So, first off, we just really want to touch on the mission statement of Yield App. I mean, we know we believe very firmly in the future of digital assets, and obviously be able to continue to earn on your digital assets, and we want to be able to provide this in a very safe and secure environment. So again, everything we do is on a kind of a 10-year outlook. And so whether we're looking to add assets, it goes through a series of DD requests and I think weeks and months of analysis, and obviously any sort of potential deployments in our fund strategies, again, like a very complex due diligence process that we go through. And so any asset that gets added to Yield App, we see as something that's going to be a staple of the industry for the next decade to come. And on this, as these questions have been coming up for months actually on LUNA and UST, and obviously we've had a very firm stance on this. And I've brought on our portfolio team today, our chief investment officer, Lucas Kiely, and our DeFi team with our head of our DeFi portfolio, and also DeFi portfolio manager with Cash. So guys, thank you for joining us.
Cheers. Hi, guys.
All right. So yeah, thanks, guys. So I think we can just jump in, and I'll pass it to our DeFi team. And guys, maybe it'd help to kind of give a recap of the events of kind of how we got here today. So I think our community would love to hear about it.
Yeah, I'll fill that one, Tim. Thank you. I think first, before we get into that, I just want to, on behalf of Yield, offer up our condolences to anyone that was impacted in what's happened in the last few days. It's never good to see this kind of systemic impact roll through the ecosystem. So while obviously Yield App in our portfolio was completely exempt from these kind of impacts, we just want to offer that out to the community members that may have also been impacted. So I guess the story of LUNA, if I just want to give a brief history from my perspective of seeing it enter the market up until today, we initially, and LUNA came onto our radar in 2019. So the project's been around for quite some time, building as an alternative layer 1 to Ethereum, with some niche differences around some validation techniques, and also like the programming languages it uses, etc., that allows for some extra scalability. Within the last 12 months, there's been a fairly large push into DeFi from LUNA, and you would have seen this a lot throughout the ecosystem as capital was incentivized to back against UST, the native stablecoin. In accompanying with that, we saw a number of different DeFi protocols roll out onto the chain, such as Anchor or Prism, and a few really nuanced things that are fairly unique to the market. However, not without that risk, of course. So what we saw with the iteration of UST dropping into the market was a different take on stablecoin elasticity as it comes to an algorithmic stablecoin. Now, there's a number of different algorithmic stablecoins in the market, and they all have different functionality and different levels of collateralization. For example, our audience is very familiar with USDT and USDC that are collateralized by US dollars, for example, that can be redeemed through their websites at any time. And we also obviously have DAI. Now, DAI is fully collateralized, over-collateralized against Ethereum, and we'll break down how that works a little bit later on, I'm sure. However, the approach that UST took in regards to being able to service a large group of people was really one of elasticity. And that means there's no fixed limit on the amount of mints, and the collateralization is very much a moving target. The minting and burning of UST is elastic in the way that it has a relationship with the governance token LUNA. And the way that mechanism works in supply and contraction focuses on the arbitrage difference. So if I have LUNA, I can mint it for UST. If I have UST, I can redeem that for LUNA. So when there is a price difference in parity of their dollar value, there becomes an arbitrage opportunity. Say there's a UST is trading at $1.10 or $1.05, for example. Arbitragers are able to mint that at a discount to the price of LUNA and net the difference. Now, the challenges we see in that is arbitrage always, when you're incentivizing something with arbitrage, is that the person arbitraging it needs to want both those assets, which brings us to our first challenge. So keep that in mind as we go through, I guess, the story of the growth of LUNA. So as Anchor hit the market, we saw a lot of attractive APYs. Obviously, we had a lot of questions from our community around how that impacted our strategy and listings, etc., and comparisons to, I guess, the service we deliver in market as far as APYs go. But what we saw from a risk perspective was at the rate that UST was expanding in the market, how much UST was flooding in because of this high APY. Obviously, that's a pretty crazy cycle when that starts to ramp up and there's APY on APY. And we're seeing that build up very quickly over time. It becomes a high systemic risk in the market as far as being able to exit your UST on a one-to-one dollar basis. So we saw that gradually creep up. The last assessment we did would have been late last year. I think the last pulse we had on the liquidity was late December, and at that time there was approximately 10% of the Anchor UST that would have been able to exit into the market on a one-to-one basis. So from that perspective alone, you can see there's a high level of uncollateralization that was very market dependent on the arbitrage, which ultimately ended up to where we are today in the last few days. As the demand for arbitrage, the arbitragers continued to push out, but we're not retaining the LUNA token as they saw more systemic risk in the value. Now this is something that we consulted a number of different funds on and the use of UST, and tried to, I guess, guide people away from exposing themselves to this kind of systemic risk in market. And unfortunately, the rate of liquidity that just grew too fast for the entire DeFi market to absorb it. So when there was a little bit of doubt, the elasticity in that mechanism unfortunately gave out, and we've seen a fairly dramatic spiral down. And this is the challenge when we have a stable coin that's backed by unlimited supply of its collateralization that can be continually minted. You put a lot of faith in people having a long-term horizon on the governance token and the stablecoin returning to peg. And that liquidity depth that I mentioned really plays into the challenge of restoring faith. And that's ultimately how we've ended up today.
Yeah, and just to add to what Reese was saying, this was a huge black swan event. Now, this is the classic death spiral, which everyone was afraid of. Like from day one, when any algo coin is born, if it's LUNA, if it's Basis Cash or anything similar, this is always going to be an issue that the LUNA Foundation Guard had to account for, and unfortunately, in this case, they didn't put enough safeguards in place. Now, it's in very simple terms, of course, a death spiral is when there's a loss of demand for UST, and which causes more LUNA to be minted, which reduces LUNA's price, which causes more LUNA selling, and which panics people into selling UST. Now, over the last week, this is exactly what happened, which is unfortunate because this attack or this issue with LUNA came at a time when there was already a market downturn. So it's a really bad, essentially, death spiral, as the name sounds. It's a really bad circle, and it's really quite difficult to stop when the market just keeps going down and down, which is what's happened with BTC. The situation.
Actually, just to briefly interrupt on this is, I think the most important thing to remember is that these type of algorithmic stable coins are most at risk in a market downturn. And the thing that I found quite interesting is, despite constant highlighting of this problem about this stable coin, people just refuse to believe that it was possible to happen. I mean, ultimately, when we take something like LUNA, if the demand for LUNA isn't there and people just don't value it the same way, then there's only one outcome for UST, and that's what we saw. And it's quite interesting from the perspective of hindsight. Everybody talking about, but this is what happened. But I mean, we've done this analysis. We went through it in detail and showed, I think, more times than once that this is what's going to happen. And we really, I think, knew from the very start that the risk to this stable coin was always going to come when there was pressure in the marketplace, because that's when these things happen.
Yeah, and look, the Luna Foundation Guard was aware of the situation, which is why very recently they bought some Bitcoin to back a UST instead of just relying on Luna itself. And of course, there was the whole creation of the fall pool. They were going to incentivize at least billions of liquidity into that fall pool, which would have required a lot more, or provide a lot more backing for UST before it got depegged. So these things were being worked on. Unfortunately, these protections weren't enough, and what happened was, just the situation we're in right now. Spoken to Reese and Tim and Lucas, of course, about how much liquidity it would take for this kind of thing to be prevented. And it's unfortunate it happened at this time when there was lower liquidity rather than when the fall pool was up and running, because that might have prevented this entire situation.
I think something that really compounded on the fact is that we've just had there's a lot of new entrants into the market, right? And we're seeing a lot of new money come in and excited money, and they're seeing these APYs, but they don't necessarily understand the risk that's going along with that, and the kind of tribalism that forms around these tokens, because there is a financial incentive, really clouds a proper risk analysis from a broader spectrum in a public forum. There's a lot of shutting down of questions, and a lot of people get pushed back at the sake of people trying to retain the value and the price of their token. And for those that have been around for, say, a cycle, typically 4 years around here, if you've been around for 4 years, you've seen this play out before. And it's just really unfortunate that my perspective on that would be there would be a lot of new market entrants that have been impacted by this. So I think that really adds to, it's very hard to challenge things in a public forum when there's such strong tribalism towards a mechanic because of the financial incentive, which it clouds a lot of judgment.
I think what's really interesting was we taught a class at the University of Chicago on applied algo trading, and a couple of it's on the Masters in Financial Mathematics program, and we were sitting there talking about exactly this problem, and the question comes up about stable coins and how they react, especially algorithmic ones, and it was kind of thoughtful in that one of the students asked us a question. It was quite a detailed question about UST, and when we explained it in the way we've just done, I think a lot of light bulbs went off, and that people realized that where the vulnerabilities are in these systems, you're kidding yourself if you don't think someone's going to exploit that. And I think this is the nature of the beast. I've been in finance for 25 years, I've seen pegs of fiat currencies try to be broken. There's obviously the classic case of Soros with the sterling in the ERM, or the exchange rate mechanism. The classic for me has always been the Hong Kong dollar peg, and how you try and break that. And it's people try to see how deep are your pockets, and are your pockets deep enough to maintain the peg. And I think we've always seen in UST that your pockets just are never going to be deep enough for the type of size that can be thrown at this problem.
Yeah, I agree, Lucas. And I think from our risk model perspective, I think a lot of our community has read through our blogs around our 135-point risk model that we've built out in DeFi.
On that, Reese, it would be great, I think, maybe kind of even covered in depth. I mean, if people have read through our risk profiles, but I think from the team behind it, they haven't heard from directly that's going to build it out, and all that lengthy process we go through before any decisions are ever made.
Yeah, sure, Tim. No problem. So the internal proprietary risk model that we've built out here, Yield App, is founded on my background is in predictive analytics, and I've been around in DeFi for quite some time now, since inception. So we pulled those things together. We historically built a database of every exploit that's happened in DeFi since we've started, and we started to measure out some critical loss vectors and key indicators. We ended up with the model that is a sum of 135 variables across 4 key pillars: market risk, smart contract risk, counterparty risk, and pool risk. And those metrics are all weighted directly in regards to the severity of impact they've had on the market previously. It's built with a very rigid approach in that our number one priority here at Yield App is customer asset safety first, not APYs. And that's our ethos. That's what we drive. And that's, I guess, that's why we're having this call today. And it really echoes, I guess, that sentiment that we've tried to push across the community around why our APYs sit where they are at certain times in the market when there is compression. And that risk model ultimately sends out a capital allocation sizing. That is our maximum allocation for that pool. As those that are aware, we have a strict risk model around a 5% allocation of assets under management from a distribution perspective. But this also works within that scale. So there may be something that only approves half of that amount to go into a certain pool based on the outputs of the metrics. And in return, we spit out an alphabet rating, which will grade the protocols. To date, we've backtested, as I said, every exploit that's happened in DeFi so far. There's approximately 125 platforms that we've taken through the risk model. So if you're thinking about it or you've heard it in market, it's probably been tested through our model. To date, there's just over a dozen protocols that have passed through that model. So hopefully that gives some context without revealing too much of the alpha about how strict that model is and designed for customer asset safety first, where we've removed all this, the systematic risk you'll see that's spilled over with LUNA. That is also assessed in the market risk side of liquidity. So hopefully that gives some color around the risk model. It is very code-based. We do look at smart contract code. Myself and the other DeFi team members have a fair bit of experience in Solidity and a couple of other programming languages. So we are in the process of building out the next model of that. We have talked about that in a few of the quarter reports, which aims to provide a lot more detailed, granular data for someone that's not super familiar with code or Solidity, so that we can present reports that is digestible from a user base. So we're continuing to iterate, but I'm really comfortable with how the model has stood up over time. We haven't even come close to anything happening, so touch wood, but I'm really happy with how we've managed to avoid all the... It's been a pretty crazy 12 months in DeFi, and we have really managed to stick to that model and prove it out.
Just as a follow-up question, do you see any algorithmic stablecoins passing the model anytime soon?
Not at this stage. CDPs, like collateralized debt, hold a place in the market, I believe. Obviously, we accept DAI. For those that aren't aware, the DAI collateralization is over-collateralized. So unlike LUNA, there is a tangible backing that sits behind minting of DAI. And that composition is primarily USDC currently. You can check those stats out at the MakerDAO website if you want to have a look at the collateralization of each DAI. It's constantly upgraded in a live database. It's primarily driven behind the Ethereum price, right? So there's an incentive mechanism that provides a discounted Ethereum in the event that collateralization drops below the DAI peg. And the Maker team have been pretty proactive in producing some liquidity opportunities for those that wish to exit DAI through the peg stability module, for example. Again, you can read about that in their docs, where you can simply swap one DAI for one USDC or Paxos. It's a fairly robust system in providing liquidity in that one-to-one swap that really avoids a lot of the pitfalls that we had with any kind of elastic stablecoin in market. And that's really an opportunity that can be capitalized due to its over collateralization, right? So if you've got something that's 150% collateralized, then you have a fairly strong buffer in which you can redeem that for the $1, right? So, and there's some great mechanics in place to keep that at that ratio as well. So hopefully that answers the question, Cash. I don't think there's anything on our radar at the moment as far as algo stablecoins. Just unfortunately, the USD failed on a few fronts. It was the model itself. The elasticity didn't make sense from a demand perspective. The liquidity was very short. And the timing to execution as far as in-market participants and who could actually get out first on the bank run was way too thin for us to even come on our radar. So they're very tough problems to fix. I do think there is a place for algorithmic stablecoins in our market. But at this point in time, with our ethos of customer safety first, the yields we pass through are, I would say, the safest in market. And for that reason, it's going to take, I think it take quite a while before we can get an algorithmic stablecoin through the parameters.
Perfect.
Yeah, and many people who've been here since 2017, 2018, before when DeFi was a thing, they would be aware of what DAI is. But perhaps like a lot of newer entrants to this, like which have only joined us the last 1 or 2 years, wouldn't have used DAI or perhaps wouldn't have heard as much about it because it's not as sexy as UST. It's maybe it doesn't get as much traction as Magic Internet Money, MIM, or any of the new ones which are happening, but. Something to do remember, and I want to stress what Reese said. DAI is over collateralized, which makes it redeemable for hard assets. But also, it's a simple design. It's battle tested. It's had years of positive growth and revenue, and it's at this stage right now. It's probably as close as what we're going to get as an on-chain bank. But yeah, the issue some people have with DAI is that it's not capital efficient yet. But they are working on that. They've been upgrading their upgrading the systems. They've got some good ideas happening in the future. So something to keep an eye on. But yeah, it's one of the assets which I think will survive the bear market. Doesn't matter how many years. It's going to keep growing. It's got a huge community and a lot of support from especially the Ethereum side of Ethereum maxis and
I think the way we should look at stablecoins is as credit instruments and what is the kind of credit rating I'd apply to a stablecoin based on the collateral that it uses behind it to support its peg or support its value. And obviously, the higher the quality of the collateral that supports the peg, the harder it is to break. And I think we've seen with algorithmic stablecoins where the problems come from, and we've seen with the more traditional asset-backed stablecoins that it's actually harder to break that peg. Especially as they're bigger and the more collateral behind it, the harder it is to break that peg. And so whenever I see a yielding opportunity in a stable coin and I look at the APY that's offered, to me, it really just reflects the credit quality of that stable coin. And so if someone's saying, hey, I'll give you 25% on this, and I know that in a basic dollar, I'm not going to get more than one, something tells me that there might be something a little bit off in the way that those APYs are being generated. So, if it's too good to be true, I think is the old saying. It probably is, and we take that responsibility, especially the responsibility that our clients give us, seriously.
Absolutely, Lucas. On that, thanks, DeFi team on really giving us that overview on the DD process, and Lucas as our chief investment officer and obviously managing a significant portion of the portfolio. Could you kind of touch on that process that you kind of go through and that rigorous and the steps involved? So
I think just firstly reiterating what the DeFi team have said is the best way to preserve client capital is through diversification, and we firmly believe that by building diversification into the overall portfolio, the assets are going to be far safer. We can handle more event risk if it's diversified across a broader allocation space. So what we did, and to be fair, is one of the reasons I think Tim brought me on board, is that we started to see a huge amount of opportunities enter the DeFi space that were too good to be true. And we thought, okay, we're going to end up having either massive yield compression as everyone chases the safe returns, or we're going to end up having to take a lot more risk to achieve the APYs that we offer. And so what we chose to do instead was to sort of build in greater diversification into the portfolio by creating stable returns through things like arbitrage, market making, and other systematic strategies. So we break them down into market neutral, systematic, and liquidity provision strategies. And we basically take some of the capital that is deployed on our platform, and we use that for market neutral strategies around the base asset classes we've got. So I'll give you a really good example. We take USDC, we take Ethereum, we take Bitcoin. And normally you'd sit there and say to yourself, okay, I've got a Bitcoin price mismatch on two exchanges, so I'm going to trade Bitcoin, buy Bitcoin here, sell Bitcoin there. And those opportunities have largely gone. And also, there's like 400 exchanges out there, and maybe 10, 15 of them would probably pass a reasonable due diligence test as to the quality of liquidity, the quality of capital that's on there. But aside from that, you want to sort of think about, well, what if I've got Bitcoin, Ethereum, and stablecoin, and I've got a Bitcoin dollar price on one exchange, an Ethereum dollar price on another exchange, and a Bitcoin ETH cross on another exchange. If I've got all three coins, I can actually run a triangulation arbitrage across the exchanges. And that is obviously quite a fruitful opportunity, because not a lot of people and not a lot of firms have all three coins. So they're having to borrow one, et cetera, et cetera. Because we have the trifecta, so to speak, we can actually run things like that. Other things we're able to do is run volatility arbitrage, especially where we look at situations in the market where you see volatility or options trading at extremely high volatilities, but ultimately are mispriced because of the way skew is priced in cryptocurrencies. And so we use some of their capital to take advantage of mispriced options. Once again, still market neutral, once again, no real risk, but ultimately we're running daily liquidity strategies that allow us to monetize the market inefficiencies. Especially the derivatives market in crypto is obviously quite nascent. So when we look at it, we say, well, there's a price on FTX that's very different than a price on Deribit, or there's a price and Paradigm, etc., that we think about. And we say, okay, well, we can trade that, flatten out the positions, and ultimately we're dealing in places where we're comfortable with the liquidity and with the credit quality of the exchange or the marketplace. And so we build a lot of those capabilities into the platform. And looking across the portfolio over the last 3 months, people can say, yeah, but that's nickel and diming and it's really hard. But we're not taking directional risk on client assets, right? We're just not in the business of trying to, hit home runs on market moves. We're trying to use the capital to generate a yield and trying to exploit market inefficiencies in scale in order to size and be able to provide the APYs that we do to our clients. And going across, as I say, the portfolio of the last, even the last 2 weeks, we've done exceptionally well across the whole portfolio. No drawdowns, no real losses anywhere. Same in the DeFi team. We've not been exposed to UST, but in the stuff we've done externally, we've also not been exposed to UST, because the due diligence that we do on the strategies we implement to, or we allocate to, are extremely robust and take us about 6 weeks to 8 weeks to do a full deep dive. We looked at a very, very famous manager the last couple of weeks. Didn't get past round one of our DD due to some regulatory issues that came up with one of the portfolio managers. And it's stuff like that. We just say, well, if we want to protect our client capital first and foremost, or capital preservation is how we wanted to build our platform up from, then it takes an extortionate amount of time and effort to actually get comfortable with, there's 800, let's say, external fund managers out there. I think we've passed 7 or 8, Tim, if I'm correct. Am I thinking that have actually passed a full DD and that we feel absolutely comfortable at partnering with? The ones that fail, well, I think we'll leave that to a blooper reel somewhere, but some of them are just crazy as to the reasons why they fail. And it's the things like why they're in UST and why they're no longer running a fund anymore after this week. I mean, lots of them have gone under. I've heard every story about why these guys are so amazing, and for the same reasons that the DeFi team fails UST is the same reason that we fail these guys. It's just their risk tolerance is just not aligned with us.
No, thanks, Lucas. No, it's very true. We're every week we're doing many kind of calls with external parties, different fund managers, some of our competitors as well, and we run into these conversations all the time, and I think people have just taken kind of a shortcut oftentimes to their own due diligence process. So, guys, a question that kind of came in right now is, we're in pretty turbulent markets. Even the last few months, I could say, I think even interest in the crypto markets has slid a bit. And how do we manage the portfolio today? And maybe I'll start with the DeFi team. Like, what kind of, how have we adjusted our strategies for the current market?
Thanks, Tim. I'll fill with that one. I think from how we operate, it doesn't change. We always put client asset safety first, as I mentioned earlier. In these times of compression, we do, and we have actually mentioned this a few times in some blogs, that during times of compression, there becomes a higher and higher temptation to push assets into riskier positions in order to maintain an APY to satisfy a client base or a return profile. We're not in the business of doing that. It's not in our makeup, it's not in our ethos. There's no one in this business that would stand for that kind of taking that kind of direction with client assets. So the way we operate doesn't change, Tim. If there is compression in market due to a lack of trading volume that comes through the market, that will impact the returns we can pass through safely to the community. And that is a compression factor. We are still sitting at the same rates that we were previously, because we have had some fairly impactful strategies over the last 30 days that have helped subsidize, but the market is definitely compressed, and we are seeing a reduction in participation from the market, which ultimately does flow through to yield. So if this does continue, a reduction in yields from the DeFi side is likely, unless we see a huge tick up in volume.
Yeah, just to add to that, I think one of the things that we built into the portfolio is the capacity to not rely on DeFi and go more towards sort of the sort of centralized exchange strategies. We have a world-class arbitrage platform across multiple exchanges that we utilize more extensively over the last 2 to 3 months, that we put in place at the end of last year, as we saw the risk return or the risk reward profiles change in DeFi. When we look at what we had in DeFi versus what we had in those ARB strategies, as the market sort of went through this turmoil, it changed quite considerably. And so the at-risk capital in DeFi got reduced. The volatility of returns across the portfolio changed quite drastically to be very, very constant. And really boring. And I think that's what we do very well, is boring. And I think what had become really interesting to us was a lot of our peers or competitors had come to us and asked if they could use our platform to help with their yields. And we just said no. We want to maintain our yields for our clients. And if we'd accepted that excess capital, all that would have happened is our yields would have been compressed along with all our, in line with our peer group. And I think we've really tried hard to maintain our APYs, but at the same time, we're a community-driven business, right? We love our yielders. We really respect the trust they provide to us or give to us, and taking more capital at the expense of those APYs, I think, would have been very detrimental to the community itself. So I think that's one of the things that, I take my hat off to Tim for recognizing this back in September, that we needed to be able to expand in order to maintain where we were. And I think that's come through in where we are with our APYs.
Thanks, Lucas. All right, we got some questions from the audience. I think we'll kind of start to go through a few of these. There's a question on the delayed withdrawals trend that has kind of been happening. You probably see that with us and a lot of the crypto companies overall in the overall scene. So, in short, I mean, yes, our vision and what we want to offer is instant liquidity, and obviously in our terms and conditions. And you can see when you're withdrawing assets, it could take several hours. We have a team working 24/7 around the clock to be able to process withdrawals. However, in these very, I guess, high volume days when you see the GUI price climb on Ethereum and the networks get congested, obviously some of our external counterparts become some of the bottlenecks on these withdrawals. So we will process withdrawals when when liquidity comes readily available. So, but I would say, I'd always say if you're kind of wanting to make movement in this industry, I wouldn't wait till I guess everyone else is trying to do it, because these networks do get congested, like us, they do, as FTX, as Binance is. So you're going to see kind of across the whole industry. So, question came in. Good question. What is the exposure for Yield App of USDT? I think that's an interesting question. Probably a number of ways of answering this, but Lucas, I think I'll pass it on to you.
So if you've given us USDT, then your exposure is to USDT. I think this is one of the things that we're quite proud of on the platform, is that what you give us is how we deploy it. We don't take your USDT and convert it to Bitcoin, and we don't take your USDT and convert it to USDC or Ethereum. If you give us USDT, we deploy it as USDT. So what you give us is what your exposure is to that asset class. What we do behind the scenes is actually quite interesting, in that we obviously look at what we've got from our clients, and then we deploy in base asset, or we deploy in kind, and it's not an easy thing to do that. And trust me, I think Tim has lost a lot of hair over the AML KYC processes we have to go through in order to be able to enable that kind of capability. But that's the risk, right? The risk is, if you've given us USDT, it's your risk, because we deploy what you give us. I think that's the best way to answer that question, Tim.
Yeah, just to follow up on that, I mean, I just do recommend everyone highly to hold and to use assets that you do believe in. So if that's a stable coin, if you have more confidence in USDC and the company behind that over USDT, I would suggest holding that and earning on those assets, because you will get in return what you actually put in to the platform with us, or anywhere else for that matter. So,
Tim, I might just add something from the DeFi side. Some of those more familiar with liquidity provision in DeFi will ask how we retain the balance. So if someone gives us $1 million of USDC and USDT, and we place it in a pool, and the pool skews one way, like we've seen over the last 24 hours, we do manage that consistently, and we monitor that frequently to ensure that if the positions do slip out of that in DeFi, that we are hedged across the business to ensure that we can retain the assets that you deployed. So while there is moving targets in DeFi, it is something we actively monitor to ensure the pool compositions stay in line with the assets that you have deposited with us.
no, thanks guys. All right, there's a bear market question that's coming in, and I think that's going to be a very hot topic right now, and like it looks more and more to be confirmed that in the traditional crypto markets we are apparently in a bear market. And the question's coming in. I'll give it to you, Lucas. Can we trust Yield App as a safe place to park their crypto assets during a bear market, and why trust us?
Well, I think the two are slightly not connected, right? The bear market is the bear market, and that affects your assets irrespective of whether they're with us or not. I think ultimately what we do with those assets is, I would say, institutional grade sort of governance, and if we provide, or we create that fiduciary shield around those assets to protect them. The way we allocate have gone through, as I say, extensive due diligence. And there's another question I saw about the models and do they hold up all the time? The things that hold up all the time when it comes to governance are the same, no matter whether you're investing in a digital asset company or any company. There are processes, governance processes. There are who has control of the keys, who does this, who does that. Are they documented? So I can give you a really, really good idea, right? So let's say I find a really amazing external manager who's doing some incredible arbitrage strategies that we love. We go and talk to that manager. He sends us a due diligence questionnaire back. We do all these things, and look how amazing we are, and look at our returns. And I've been doing this job for quite some time, and I remember, some of you might remember Virgil as a fund that I think the founder of that is investigated by the SEC and got himself in all sorts of trouble. the reason why these companies fail when we do this is we don't just accept their word. We go and talk to their custodians. We go and talk to their auditors. We go and talk to their accountants. We check with the SEC or other regulators. We do background checks on the principles. We have a one manager who we spent probably 6 weeks working with an external custodian, a very famous external custodian, going through their books to make sure that what they said on the tin is what they were actually doing. And it's not a quick, oh, I trust you. You've got all these guys who've given you money, because we're just not in that. I remember doing due diligence on Bernie Madoff's funds in the early 2000s and just saying, yeah, no, can't trust you guys. Don't think that's going to happen. And the amount of pressure that we get from, oh, but these are our LPs. These are the people who have allocated to us. We just don't care. And the reason why we don't care is we care about our clients and their capital and preserving it. It's not the case of saying, oh yeah, but we couldn't have known because all these other guys are in it. We do know, and we do care. And so the process around safety isn't just about a bear market. It's about any market. I don't care what market it is. For me, it's about making sure that when we deploy capital, we are 100% sure that it's safe. And it's places that we would put our own capital and have put our own capital. It's not about whether the market's going up or down, because I've seen bull markets where the manager's gone under, right? Or the strategy's failed. So yeah, I'd argue that we care any type of market. And if people, when we get people to do due diligence on us and audit us all the time, and we've got statements and from regulated companies that show that those assets are safe and the performance is there, and we obviously we take great pride in that, and we have a full on-chain analysis of every coin that's ever been deployed, where it is at any period of time, and we run that daily. So I'd say we're pretty confident that all the assets are there.
That's very cool.
I just want to add something onto that as well. Like, I know there's going to be a lot of questions about bear market and crypto and DeFi, and that's warranted given that what's happened over the past week and over the past couple of months, really. But I mean, it's not people worry about the bear market, but the reality is it's going to be a lot quieter. And if people really want to get involved in the space, this is a great time to learn and start working on DAOs and in DeFi and risk management, whatever you're interested in. Start learning coding if you want. So this is like a perfect opportunity for people who are new to the space to really get involved, start properly learning about what actually happens. And it's a good opportunity that people really should take on if they're keen to stay in the space for a long time. So it's not all bad news. I know it's not probably won't be as as exciting as the last couple of years, but that doesn't mean there's any lack of opportunities around. So this is something like if people want to get involved in looking at different stable coins or proposing risk assessments on what assets that companies like Yield App or Nexo and Celsius should be using. It's a great time to get involved in that kind of research and look at information yourself on what works and what doesn't work.
Yeah, absolutely. Thanks, Jazz. All right, questions coming in, and I think it's a lot of this is going to be really relevant today, and a lot of the DeFi insurance industry, a lot of policies out with UST. The question is, does Yield App have plans on implementation, and what are the trials and tribulations? And Akash, you've worked on this problem for the last year with Steady State before joining us full time, and I know you're still involved over there, and the rest of our DeFi team is actively involved over there. You guys want to kind of give a glimpse into what's kind of happening and what to kind of expect on this last week?
Well, the Steady State team's doing great work. So we've had John Libby a couple of times on the Yield App AMAs. They're super busy building out the actuarial model. As everyone in this space would know, it's really hard to. I mean, everyone knows what the risks are. Like we had the DeFi team earlier, and as long as Lucas and Tim just talk about all the risks with UST and the proposed risks, the risk management system that we use. The issue really comes is how do you quantify that risk, and that's been the greatest challenge that we've had for the past 6 months. And Jonathan and the actuary in house, Michael, have been working on that issue for a long time. It's an evolving market as well. Essentially, new protocols will come on that we have never seen before, and we have to try and figure out how to assess that risk, then how to quantify that risk. and there's a significant lack of data in this space. Like DeFi is only like 2 years old. That's, I mean, any traditional insurance expert will tell you that's just not enough data to even like figure out what how to quantify the premiums and figure out what the risk ratings are. But that's what we work. That's what State's been working on past few months. Just trying to really get down dirty into DeFi. Just trying to figure out what how we can figure out what the real risk factors are. But we're using for example, we're obviously using risk management systems and assessments that we have in house. Just collecting as much data as we can on what's happened in the space for past, 2 to 3 years in DeFi, looking through audit reports, what went wrong, what's going right, what protocols do to protocols such as Curve do to make sure hacks are avoided. And it's been a huge challenge because every single week something new goes wrong. So that's more data for us to consider. It's a really exciting time and something to keep an eye on. I think they're going to release come through with an MVP and new models very soon for the public. So it's an exciting time to be part of insurance. Not something which can be done overnight, unfortunately. But yeah, it's that's essentially what the situation is like over there.
Yeah, thanks. And to our head of DeFi team, anything to add, especially kind of on how do you kind of see the fallout, or what's the sequence of events that are kind of unfolding right now, and kind of what do we anticipate things to look like in the coming weeks?
From a LUNA UST perspective, Tim?
Yes, I think that would be a good topic.
Yeah, it's very difficult to tell. We've seen in the past 24 hours a few stoppages of the chain. I actually believe it's halted right now, which is obviously stopping a lot of the sell pressure on LUNA. As I explained at the top of the call, that elastic supply means LUNA continues to expand and provide arbitrage opportunity until UST retrieves its peg, which from my modeling, we'd be looking at least 2 weeks for that to happen naturally. Upwards of 30 to 50 days, depending on where the price of UST sits and the market cap of LUNA sits. But that looks like it's such a moving target. It's really hard to say how that pans out. But I think halting the chain currently, while it's not in, I guess, the best ethos aligned with decentralization, it's something that probably needs to happen right now for them to reassess. Like I said, there's some great protocols over there. It's really unfortunate to see them impacted by a systemic risk like UST, and hopefully they do expand across onto some other chains and bring that product suite, that suite over. It's hard to say, Tim, where the ecosystem goes from here. It's going to be a very hard comeback. The confidence is like algorithmic stablecoins at their best it's so much a confidence game, right? The same way as like knowing your money's in the bank is a confidence game. Yes. So that kind of doubt that's been cast across that particular ecosystem is a very hard thing to recapture from the market confidence, especially after there's been obviously a lot of people impacted and newer participants, as I mentioned. So we'll see how they come. Hopefully there's a statement from Doe soon about what their plans moving forward. I know there's a lot of capital backing the chain. So we'll see that hopefully a confidence statement come around a relaunch, but I think that confidence piece is going to be very difficult to recover.
Yeah, just to...
Sorry, go on, Tim.
No, just to really kind of touch on this. I mean, this question comes up oftentimes of the insurance aspect of how do you properly manage this capital? How do you insure against this? And I think what it's always kind of come down to is having the proper people, processes in place, and obviously we've built a world-class fund management team. You've got a chance to meet some of these people here today, and obviously our tech team, our development team behind the scenes, and all the security layers that are built out. And so obviously our main focus is just continue to building, and obviously it's really what happens behind the scenes. And I think this is giving you guys hopefully a good glimpse into all the work that goes into everything that we're doing, and we're just trying to make it very simple for our clients, right? That value proposition that ultimately we want to offer to our client base is the safest way to earn on your crypto assets. And we're building a place, and we think we've been very successful to date, and I think we're very confident in where we're going, and our community continues to grow on a daily basis, and as we continue to expand our security protocols moving forward. So And you were saying, Lucas?
Yeah, I think it's a couple of questions that come up around like, oh, when do you think we should get into Luna, or when should we do? I mean, I think ultimately, I'm never going to give anyone financial advice, right? I'd say, if you feel that you want to, take a punt, go for your life. But here's what we don't do, right? We don't sit there and say, I like the idea of UST, so we're going to get into that, or we like the idea of this because we're going to get into that, because we're not dealing with our money, we're dealing with your money, and when we're dealing with your money, it's a very different conversation, because your risk appetite isn't, you're not giving us our money to go and make outsized returns. You're giving us our money to look after and keep safe. And when we look at that, I'm not going to sit there and say to our DeFi team or anyone that works in a portfolio, hey, wouldn't it be a really good idea if we go and see if we can make some outsized return on this new stable coin or this new algo? Because I mean, that's a choice you can make with your own capital, but it's not a choice that we will ever make with your capital. And I think that's the first thing when it comes to safety is we focus firstly on the capital preservation. What is the real risk of you or that capital not making it back to a safe custody? And I think just seeing the last few weeks play out and seeing the deliberations that have taken place with some of the biggest managers in the world, and I think our DeFi team has every reason to feel a little bit smug sometimes about some of the conversations that we've been privy to, and the language and the swearing that's gone on when we say, yeah, not going to happen, has been quite rewarding over the last few weeks. But at the same time, we're not here to gloat, because I don't think that's the right answer either. But if someone said to us today, hey, we've got this great idea to fix Luna and UST, yeah, I'm sorry, but I'm not going to spend that much time on it, if I'm honest with you. I'm just going to say, hey, I've got better things to do and better opportunities that to me are a lot safer. Ultimately, people trust us, and that's where we value the most from our community, is the trust they give us. And I'm not going to even start to think about breaching that trust on some new idea that isn't going to pass muster.
Okay, I think we're gonna have one more question. I think that's coming in. I think it's about our different strategies in the different markets. It's do we employ leverage on the assets in any of our strategies, and could you kind of explain our systematic trading strategies? So I think Lucas, I'll leave that for you.
Okay, yeah. So we have two main systematic trading strategies, broken down into liquidity provision, which you can call sort of, how does the market function? How do you get prices in markets? Is by having that liquidity there. We do provide liquidity. We have an exceptional strategy that has been around for about 4 or 5 years, that some of that capital is deployed into. Arbitrage obviously also provides liquidity provision. We're not really in the lending game, so to speak. I mean, in DeFi is slightly different, but on the external stuff, we're not really in the lending game. We've looked at collateralized lending. It's not really for us in any real meaningful size. But the systematic stuff is where it gets really interesting. So when we see, price discrepancies, when we see arbitrage opportunities across things like volatility surfaces, relative value, or some trend following, some systematic stuff, or trend following momentum, mean reversion, we start to look at that. We don't have anything in real size in there. Why? Because I've actually seen, if you take something like systematic, like mean reversion, momentum, they're generally the same strategy, or they're in the same strategy. So you're either following the momentum, or you're reversing that momentum to go the opposite direction. Essentially, you're guessing the direction of the market, and we don't really have real exposure to that, because I've seen the other side of it. There was a really interesting fund years ago called Crypto Lab, based out of Moscow, bunch of Stanford grads, that had a trend following mean reversion strategy, and it just blew up. And the reason it blew up is because they got caught out in that March 2000 event, and they were the wrong way around, and you don't really recover from that. So on the systematic stuff, the most of it is really about making sure that we're running market neutral, no real exposure to the direction of the market. It's kind of like a nickel and dime business. It's very slow. It's basis points a day, sort of trying to achieve 75 basis points to 1% a month. Some days you're flat. I mean, if I look at the returns and the Sharpe ratio or the risk reward, we're running at about 3.5 Sharpe, which is pretty good for what we do. One of the questions that Tim always throws up at me is how much can we scale this, and how much of that capacity do we want to give to institutions versus the community that we have. But ultimately we can scale, but we like to scale organically and grow with the community. But the strategies themselves are very much market neutral, non-directional, really just opportunistic strategies that just keep the market functioning, is the best way to describe it.
I'll cue in that from the DeFi side, Henry, regarding the price of BTC or ETH. If any of the assets drop, there's no risk to the funds you have. We stay market neutral all throughout DeFi. That's our bread and butter. That's what we do. Doesn't matter what the price of Bitcoin is. Doesn't matter what the price of ETH is. You'll get them back one for one, my friend. So rest assured that there's no directional stuff going on that could potentially impact your asset holdings at Yield App.
So, I mean, just to add to that, Reese, I mean, if you want to get a kind of exact number as to the performance of the portfolio in arbitrage over the last 10 days, it's up 0.4%. So the assets we started with versus the assets we have today, we're up 0.4% in a market that's gone from go to woe, and it's been quite horrific. So if that should give you some kind of peace of mind in that we've done, I think we've done the right thing with the way we've deployed and utilized that capital. And I think we're probably about similar on DeFi as well, Reese.
Yeah, absolutely, mate. No, not shocked at all. In fact, a lot of the movements around the market have been good in the last 24 hours, with a lot of fees being generated as people have. There's been a lot of panic, of course. So that's generated a fair bit of fees. So it was quite a profitable day from an LP perspective yesterday, but no doubt that will subside.
All right, we'll do one more quick question, and that's people keep asking me that. So we'll go for it. In the unlikely event BTC goes to 12K or even 3.5K, well, we already know that our funds are safe.
If you gave us Bitcoin, then your funds are still in Bitcoin. If you gave us stables, then you're in stables. What do we do with the stables? We're using them to generate yield. We're not using them to take bets on whether Bitcoin's going up or Bitcoin's going down, or whether Ethereum's going up or Ethereum's going down. So, I mean, as I said at the start, if you gave us whatever base asset you gave us is how we deploy, and our exposure to the marketplace is non-directional. So, if BTC's at 3,500 and you've given us BTC, I think you've got that risk. I mean, we're not going to give you back the dollar value of your Bitcoin. We're going to give you back the number of Bitcoin plus the APY on that we promised you.
Yeah, and I've only joined recently a DeFi team, but just to add to that answer as well, like the amount of research and alpha and the amount of information they get every day from different protocols, different all parts of different chains across DeFi. They find enough kind of yield to keep the assets one-to-one rather than convert the assets or borrow lend against them kind of thing. So there's no real risk or leverage or anything like that, because these guys have been great and creating these systems which allow them to find yield and keep, especially in very safe and secure protocols, as we spoke earlier about the the risk assessment models that we have. So yeah, there's no concern about the assets at all at this stage, and they'll say that way in the future as well.
No, perfect. I think we'll kind of wrap it up there. Thank you, gentlemen. For the community, thank you guys for tuning in today. You guys can head over to our blog and got a lot of good material coming out recently, obviously on the UST. Investing in a bear market And I just want to kind of really just end with, this is why we've built Yield App again. Is it's a very complicated world out there. I think you get a glimpse in all the complications that go behind the scenes with the trained professionals. And we've wanted to really make this simple for to be able to earn on your crypto and continue to grow your crypto wealth. So, anyways, thank you guys for joining us, and we'll have to do this again soon.
Pleasure, mate.